Olá pessoal, boa noite, sejam bem-vindos a essa transmissão especial. Sou João Vitor Possamay, CFO do Asaas, e hoje teremos um bate-papo incrível sobre Valuation, Science, Art and Magic com o professor Damodaran, que é professor de finanças da Stern School of Business da NYU, Universidade de Nova York. Essa conversa será uma pequena prévia dos diversos conteúdos que você vai encontrar no Asaas Connect, um evento sobre tecnologia, negócios e finanças que está sendo organizado pelo Asaas. Está marcado para o dia 5 de outubro lá no espaço Transamérica Expo Center em São Paulo, capital. Nosso evento terá nomes como Camila Farani, Renato Monteiro, Nina Silva, Leonardo Rebite, Guga Stocco e muitos outros. E se você ainda não comprou seu ingresso, chegou o grande momento. Está aparecendo agora aqui na telinha um cupom de desconto de 20% para você garantir a sua presença. Basta acessar o site asasconnect.com.br e durante a compra do ingresso é só inserir o cupom no local indicado. Aproveite! O bate-papo de hoje vai ser conduzido em inglês com o nosso convidado e para garantir que todos possam acompanhar a conversa, a gente vai ter apoio de legendas durante toda a entrevista, tudo bem? Então vamos lá. How are you?
I'm good.
So I'm extremely happy to be able to have this conversation here with you today.
I'm glad to be on.
So just to introduce myself very quickly, I'm the CFO here at Asaas. We're a fintech here in Brazil. And well, I'd love to pick your brain and hear your thoughts a little bit on Brazil. So in your classes, in your articles, I've noticed that you consistently use Brazilian companies as cases or examples. Could you tell us how your relationship with Brazil started? How long have you been following the Brazilian market? How did it spark your interest at first?
I mean, let's face it, Brazil is if you're going to talk about Latin America, Brazil makes the most sense to focus in on because of its population. It is the center of Latin America, no matter what the other countries might claim. So if you're going to talk about Latin America, and I really think if you're going to teach a class in the US, you have to bring Latin America into the conversation. You have to bring Brazil in. My connection with Brazil is personal. It goes back to 1997, which is the first time I came to Brazil. I came on an invite from IBMEC in Rio to come and teach a class in valuation in 1997. And I tell Brazilians, look, because I come on infrequently, I used to come once a year from 1997 almost to 2018. Since then, I've come back only once. I said, look, I have the benefit of being able to leave and come back, so I can see the country change more than those people who are in the country all the time. Because they're too caught up in, and I don't blame them. It's when you're in the middle of things, you don't see things changing around you. The Brazil I visited in 1997 was obviously a very different country than the Brazil of today. It was still living with the trauma of hyperinflation. And it's a lesson that I still bring whenever I talk about inflation, is inflation is not just a number. It's not something you pass through into your Excel spreadsheets. It traumatizes people. It changes the way we all behave, investors, businesses, consumers. And it changes, that behavior change stays on even after the inflation is gone. The example I give again in Brazil is it took almost 15 years for the trauma of hyperinflation to be gone enough that the Brazilian government could issue long-term bonds in reais. I mean, even the Brazilian government could not issue local currency bonds because people didn't trust the currency. Because inflation really brings out how little you actually have in your hand with paper currency, right? It's just paper. If the government that issues the paper becomes trustless, then the paper loses all of its value. So I think the reason Brazil found its way into the conversation into my classes is it gave me a way of bringing in companies that have to deal with maximum uncertainty in the macro environment, how they find ways of doing it in healthy and unhealthy ways, because I've seen both play out in Brazil. And I think it also allows me to ground my students in when they complain about uncertainty in the US or Europe. I said, you haven't seen real uncertainty until you're in an emerging market. We have political, economic, commodity, currency crises all playing out at the same time. And I said, look, you don't have the option of saying, I'm going to just sit on the sidelines. which a lot of US and European investors say, let's just wait for the crisis to pass. You don't have that option. You got to live through crisis, you got to manage through crisis. And in many ways, it allows me to bring that lesson home when I talk about Brazilian companies.
Over the period of time, I mean, in your classes, you talk a lot about equity risk premium. It's crucial in part of your work. So how has the equity risk premium in Brazil evolved over time in your perception, and how does it compare to other important Latin American economies like Mexico or Chile?
The price equity risk premium is just the price of risk in markets. It's like a thermometer. It gauges the temperature of the market. It's your, receptacle for all your hopes and fears. So what I'm going to say about the equity risk premium will not be surprising for anybody who's lived in Brazil for the last 25 years. It started in the late 90s at a really high number. You were coming off truly emerging market status. It kind of peaked just before 2001, 2002, Lula's first election. You saw that people worrying about, hey, maybe this will be nationalization, the end of businesses as we know it. Lived through it, and then it went on a decade-long run where Brazil started to look less and less risky each year. And you might remember there was a time late in 2010, 2011, when people were convinced that Brazil had arrived. It was a developed market now. All those bad things were behind it. Your world-class companies, everything was going great. But in emerging markets, always 3 steps forward, 2 steps back. And Brazil is the same case, often in giant steps forward and giant steps back. And the last decade, Brazil has taken steps back. It's become riskier, which tells you that the path of history is not an arc where you go from high risk to low risk and then settle into mature markets. It's essentially you go in steps. The only country that seemed to have avoided that was China. And we're discovering the reason they were able to avoid it is often they did not let bad news out. And sometimes it's healthier to go 3 steps forward, 2 steps back, than rather than try to go 9 steps forward, because then you overreach. So I think that if you look at the equity risk premium for Brazil, I think the lowest number, so if you think about the additional risk premium for Brazil relative to a mature market, say the US, that number bottomed out, I think, in 2012. That was the lowest number that I've seen. It went back up 2014, 2015. And in 2022, you look at Brazil looks like it did in 2005 or 2006. Much of the benefits of that big surge have been wiped out because of political crisis and economic crisis and their dependence on commodities.
Yeah, that's a great point. And talking about commodities, that they were a country that's very heavily concentrated in commodities, right? And it creates some difficulties for investors and challenges for investors to navigate. So, how can investors think about and navigate the challenges of valuing companies in a country where commodity prices have a very significant role in market movements and companies' profitabilities? How can they operate in that
Don't lock
environment?
yourself into a country. Investors should not think in countries. This is not an exercise in patriotic duty where you got to invest in your own country because it is your country. You can love Brazil, you can believe in Brazil and invest in Argentina and, in Mexico, in the US. Investing is about preserving and growing your wealth, not showing how patriotic you are. And I think Brazil has fewer restrictions on people investing overseas in countries like India, where you actually have more difficulty investing overseas, which is part of the reason the wealthiest Brazilians, put their money in Miami to invest in mutual funds rather than Brazil, which is, I'd rather that happen within the country. Basically, you have a full choice of mutual funds across the world because investors shouldn't be over-invested in their own countries. I know it sounds odd, but it's called a home bias. It's true around the world. Americans are guilty of it as well. They over-invest in American companies. The advantage that Americans have is the biggest American companies, the companies in the S&P 500, are really global companies. You're getting global diversification without really trying. Brazilian investors, if you're not careful, you over-invest in Brazilian companies. You invest in the Bovespa, a few of them, like, Embraer might be global companies, but a lot of them are domestic companies that get the bulk of the revenues in Brazil, which means when times are hard for you as an individual, you've lost your job, the economy is doing badly, and you look at your portfolio, guess what? Your portfolio is also going to be doing badly. And that's a risk rule in finance you do not want to violate. So rather than trying to guess the direction of commodities or make a bet on a country as your big bet for the future, I would say spread your bets. I mean, it's better to be humble on this one and not try to call markets and commodity price trends.
Going back a little bit on what we were discussing before on how Brazil has evolved on the equity risk premium compared to other Latin American um, countries, and it seems like Brazil has taken more steps back than its peers, right? Its Latin American peers when we
The
think of the
pairs.
last decades.
This is the essence of pricing, right? You let me compare you to the right country, you look great. I mean, relative to Venezuela, you look amazing. Better,
That's true.
So, and I think, in a sense, the other countries that had moved ahead of Brazil, which is Peru, Colombia, you're seeing the two steps back now, right? And this is across Latin America. So rather than beating themselves up for being bad, which is what a lot of Brazilians do, we can't get this done. Recognize that this is a phenomenon that in Latin America you're overcoming. It's not just the economic issues. You're trying to build a political structure that is solid with an economic structure, and that's never a smooth process. I mean, even Chile, that's been the outlier in this process, consistently the lowest equity risk premium of any Latin American countries. You've seen a few steps back in the last few years. So maybe Chile will revert back to the pack, and Brazil will move back to where it belongs. But the truth is, with its population, as Brazil goes, so goes the rest of Latin America. You cannot have a healthy Latin America with a Brazil that is not healthy. It's just not doable.
And in a recent interview that I watched, you talk about how Brazil has this permanent boom and bust feeling, right? People are either feeling very good, and we think that the future is now, right? We call ourselves the country of the future, but in days like these, we think, it's the future that never arises, right? Like we're always the country of the future, but we never get there. Where do you think we are in that cycle of boom and bust here in Brazil?
It might be the espressos. You guys drink like crazy, like those 15 small cups of coffee. I think it makes you really hyper and really over optimistic when things are good and brings you down when things are bad. But the truth is, Brazilians have been waiting a long time for to become one of the. I mean, I think the need to belong is what's driving right now this thing about BRICS, which I've never quite understood what holds together Brazil, Russia, India, and China. But I think this need of where on the world stage. I would I know my advice to Brazilians is find your own path. You don't have to be it's not like the rest of the world is incredibly healthy either, right? I mean, Europe is an aging region of the world. Japan is old already. The US has its own shape. It's not like anybody's found a template for success. People used to think China's done it. Look at China. We're discovering the underbelly of China. Brazil has to find its own natural pathway to develop. And I think it's better to do it to do it one step at a time rather than say we're going to become a world power in 4 years. No, I mean, this is exactly the kind of problem that the Olympics and the World Cup brought in the last decade. Is if we're ready for it, we'll have arrived. You know, I think that part of being a secure country is not worrying about what the rest of the world thinks about you. And I would love for that to be true for Brazilians because, what, you're too proud of people, too good a country for you to be thinking about what do Americans think about us? What do Europeans say? What does it matter what the rest of the world thinks? And you're not alone. I mean, India is still feeling its oats on, they still measure themselves on what the rest of the world thinks about them. And I think that one way you've arrived is when you measure yourself up against your own expectations rather than what other people expect of you. And I think if you can do that, then you can devise healthier pathways to getting where you need to be.
Great. That's very, very good advice, I think, for all of us Brazilians, we do tend to. I'm very guilty of the espresso part. I probably drink 7 or 8
I love
myself.
I love your espresso. I know I drink it every time I come there as well, but the caffeine hits you like a fiend in about 20 seconds. No?
Yeah, it does. And that boom and bust cycle, we're just recently, if you think of that in interest rate terms, right? We saw the hyperinflation and the rise in interest rate in the 90s. We just went through a cycle again during COVID of reaching all the way down to 2% interest rates, and then we had to raise interest rates by over 10 percentage points in
Right.
12 months. But over the last 12 months, we were actually able to control inflation from double digits back to 4% over the last 12 months, right? But at the end of the day, when we think of equity risk premium, of returns, of local returns that you talk about a lot in your classes, when we think of valuing companies here in Brazil and doing the exercise of valuation, how can we how can we look at long-term investments in a local market like here, where volatility and inflation and interest rates just shift so fast, right? Like
The
interest rates
thing,
going from 2% to 14% in a span of 18 months.
the things you control and things you don't, right? Worrying about things you don't control is a recipe for frustration. Of course, interest rates will swing. But unless you have a sense of the direction they're going to swing in, that's kind of neither here nor there, right? So interest rates could be higher or lower. Okay, what do I do now? I just have to use what I have and be ready to adapt. I mean, if there's one thing that you get out of volatility, is you got to be adaptable. You can't be rigid. You can't fall in love with the thesis. You know, so many people have stories they're telling about markets. They fall so in love with their story that they will, it's called confirmation bias. They will look for evidence that backs up whatever they want to believe, reject things that work in the opposite direction, and end up stuck on a thesis that heads to nowhere. So I think the key when you live in volatile environments is you got to be adaptable, you got to be flexible, you got to accept the fact that you're going to be wrong 100% of the time, and be ready for what you plan to do when you're wrong. Not if you're wrong, but when you're wrong, because you will always be wrong. I think adaptability, and I think if you think about it, the very best Brazilian companies are much better at being adaptable than the very best US companies, because you've had to adapt to kind of survive over the last 20 years. It's built into your DNA. So in a strange way, the return of inflation to developed markets might give emerging market companies a significant advantage, because US and European CFOs got really lazy and really sloppy for 20 years of inflation staying at 1 to 2%. They stopped thinking about inflation explicitly. And Brazilians could lecture them on what happens when you stop thinking about inflation, because inflation is like a genie in a bottle. You let it out, it's not going back in there easily. It's painful.
Yeah, that's incredible insight there, and it's something we've experienced firsthand here, um, with all of those swings, and certainly seeing the movements in the U.S. We, at least me being back in Brazil now for 11 years, seeing those movements in the U.S., I could see that, with a little bit of hindsight, I could see that it was not going to end well in terms of inflation, since we've seen this movie play here so many times. Um, one thing we talked about a little bit before was how, you know we Brazilians, I guess, um, care a lot about how we are viewed in the global scene, right? And at the end of the day, I think maybe we were spoiled in the 2012 or after 2007 or so, with an influx of investment from abroad, right? Of foreign
And
investment.
that's the worst way to perceive how you're viewed, is by how much money is coming into the country. Unfortunately, in much of Latin America, that's become the symbolism. Where we've arrived, look at how much foreign institutional investors are the biggest sheep on the face of the earth. They will be with you today, they'll be gone tomorrow. If you judge yourself based on how foreign institutional investors view you, it's going to be manic depressive. It's going to be great one moment, it's going to be awful the next. It's not a healthy way to run an economy, run a market, is be constantly at the mercy of foreign institutional investors directing the money in and out. See, almost if you run a company in Brazil, you almost have to run it in spite of what foreign institutional investors want you to do. You have to run it for the long term, recognizing that they will turn on you in a second, be gone for a couple of years, and come back roaring 2 years later. You cannot run a company to make foreign institutional investors love you, because the kinds of things you will do will actually be very destructive to you from a corporate finance basis.
And then trying to play this long game, how can, right now, I mean, at the end of the day, if you look at the last year or 2 years or so, it seems like Brazil has done its homework on controlling inflation and is now in a much better place than it was, right after COVID, compared to its peers that are still seeing
Yeah,
maybe higher inflation or double digit. But we haven't seen,
need money coming in.
foreign investors raise their interest here in terms of actually investing more, right? Like multiples on our
Well,
Bovespa remained historical lows.
it's bad
So
timing. It's bad timing because risk capital starting, I mean, and I've chronicled this on my blog, starting in about the middle of 2021, risk capital has been withdrawing from the market. And in a sense, it was long overdue because you had a decade where risk capital is capital invested in the riskiest companies, in the riskiest emerging markets, in the riskiest segments of each asset class. Money losing companies in the equity markets, high yield bonds, in the venture capital space, in idea companies rather than more established companies. You know. So risk capital is this lubricant that drives the riskiest parts of the market. And for a decade, it was available in excess. In many ways, Brazil missed out the best decade for risk capital because it had so many internal issues. Because the last decade, risk capital was just heading wherever there was risk in massive quantities and accepting low risk premiums. But that couldn't have survived. It wasn't healthy for the global economy to have that much risk capital sloshing around. You had bad companies being held afloat by influx of venture capital money and risk capital. So that started in 2021 to withdraw, and as inflation came back, it withdrew even more. It stayed on the sidelines. Look at how few IPOs there have been. Even though the market seems to have come back, risk capital still isn't back. You're not seeing it in the VC market. You're not seeing it in IPOs. You're not seeing it in high yield spreads. And it will it come back? It will, but I don't think it's going to come back the way it did in the last decade, because that wasn't. You're going to come back to a healthy stopping point, I think, which means that Brazil might have put its house in order, but the risk capital is not there right now for to come rushing back. But it'll build up at some point in time. Risk capital will come back. So Brazil, the one thing Brazil can't do is lose patience and try something in a hurry to get risk capital in, which is offer special tax deals for foreign institutional investors. Emerging markets often do that. They want to speed up the process, and in the process, they often make things worse for themselves in the long term.
catching that moment in the market that we live today, and in general, right? It seems like there's a lot of foreign funds not definitely not going to Russia anymore, maybe not going as much into
India,
into
India,
China as before.
India is the big destination because there's one thing that countries can't create out of thin air, which is a big population. I mean, let's face it. If you think about the country, a Slovenia or a Hungary, no matter how fast they grow, can't be the engines for the global economy. India and China have 1.5 billion people each. That gives them a place at the table because that's a huge market. Brazil has the same advantage. A Chile can never do what a Brazil does in steady state. If you think about the potential for the two countries, Chile can't have the potential that Brazil does, simply because Brazil has the population to back up demand internally. I mean, you can be an export oriented country, but how far can you go with that before some other country becomes a cheaper destination? So Brazil has an advantage, maybe not as big a population as India, but still a pretty large. I mean, it's one of the 10, I think, highest populations in the world. I think 5 are in Asia, but I think in Latin America it clearly dominates. It'll be the biggest country if it were in Europe. You know, and so I think that Brazil has that advantage that cannot be taken away by any other Latin American country, which is why I said as Brazil goes, so goes Latin America.
We are today very much. concentrated in export-based commodities, right? If you look at the 10 largest companies by market cap still listed in the
Yeah.
Bovespa today, they're the same ones from 20 years ago, right? They're either Petrobras, Vale, or the banks. So
Yeah.
how can we escape this maybe internal bias of just seeing ourselves as an export country and actually diversify our
The only
economy?
way, the only way I can explain it is the businesses that cater to local consumption tend to be privately owned or privately controlled. That because I can't imagine that there's not enough demand on the ground for things Brazilians buy where you don't have value. The value right now might be in family owned companies that are perfectly okay serving a Brazilian market and making enough money on it and don't want the scrutiny that comes, the monitoring that comes, the control. I mean, Brazilian families value control more than sometimes their own company's health, which I think is something that I've kind of argued with family control companies. Is do you value control, or do you value building a bigger, more valuable company? And many of them choose control. And I have a feeling that a lot of domestic business in Brazil is still dominated by privately controlled entities that basically are perfectly okay with things as they make enough money. They could make more, but they really are not that interested in going for that extra. So I think that the question is if they will at some point in time succumb to the equity culture and decide to get publicly listed. And that usually happens only when you have family members who are ambitious, who want to think beyond what can we do in Brazil to what can we do the rest of the world. You know?
If you look at the last 5 years or so, we did see a bit of an influx more in technology and VCs
Mhm.
investing in Brazil. And Brazil has been relative to the rest of Latin America, has been one of the
And
big
the hubs.
destinations there,
Yeah,
one of the hubs. We did see
yeah.
a few Brazilian companies even get listed in the Nasdaq, and a lot of that has been maybe part of what we discussed before, how Brazilians like to be seen abroad, right? But they seem to be breaking a little bit from the traditional view of an export-based country, and they're serving the local market with technology and trying to attract those types of
And
investors, right?
that's a good opening. I mean, I'll use India as an example of how things evolve until the 1980s. Indian markets were dominated by family group companies. Many old time manufacturing companies controlled by families with connections who knew how to play the bureaucracy game, get permits and licenses, and succeeded. And then in the late 80s, you had the first Indian tech companies, which essentially did not have family backing. Infosys, you had a couple of other outsourcing companies. They were low tech companies. In other words, they weren't inventing software. They were doing the office processing with software for US and European companies. But they succeeded beyond their wildest dreams. They rose through the ranks to become, two of the 10 largest market cap companies in India. But I think that once that happened, it gave confidence to other startups to say, look, we can pull that off. So you look at the Indian IPO market, it's been insanely active, perhaps too active in terms of the kinds of companies going public and what they're raising money for. Just 2 years ago, it's Zomato. It's an online delivery, like a DoorDash for India, but actually precedes DoorDash. Large market cap. You had Paytm, Indian payment processing company. So you're seeing these Indian companies break the mold. But what allowed them to do that was a recognition that you did not need family capital and family connections to win at this game. And hopefully, this new wave of Brazilian companies, if a couple of them can break through and become, but they have to break through and become companies that everybody recognizes, names that people recognize because they have a relative that works at it or they've made money on it. That is really the key to opening up an entire entrepreneur and equity class, saying we can do that too.
When we look at those companies and the culture right now in Brazil, a lot of these tech entrepreneurs, there's these new people that are creating companies here. They do sort of have that dream of listing in Nasdaq over the Bovespa, right? Do you have a view whether it actually makes a difference to open locally
I
or
don't,
opening abroad?
I don't think it matters. I mean, Alibaba is listed, was listed on the Nasdaq. It's still a Chinese company. I mean, listing to me is the least interesting of all of the choices that a company makes. I'm much more interested in where do you sell your stuff? Where do you run your operations? Where do you produce your stuff? Listings are really a function of liquidity. And let's face it, the NASDAQ is much more liquidity than any other high tech market you can go listed in. And liquidity is good because if you have millions of shares trading, you don't have price manipulation, which you worry about in thinly traded markets that a few people with big positions can move the stock price. So I can understand why tech companies are listing on the NASDAQ. You'd want the Brazilian market to get rich enough and liquid enough and deep enough. But for that to happen, Brazilian mutual funds have to be routinely looking for tech companies to add to their portfolios. And until that happens, they're going to go elsewhere to get that liquidity.
In those terms, do you have any advice for tech companies like us here at Asaas? We're trying to drive growth in the domestic market to attract foreign capital, attract foreign investors, and actually have this sustainable long-term growth. What advice do you have for us
Build a
dealing with
business.
all of those issues?
Build a business while you're scaling up. I think too often, I mean, this is not just you. I think across the world, my one of my problems with how young tech companies approached their building up process in the last decade is they were so intent on scaling up because that's what VCs paid for. How many users do you have? How many downloads? How many connections? How many subscribers? That they forgot that ultimately you can't pay dividends and cash flows with users. You need to convert, you need to monetize those users. And that is hard work. The fun work in these businesses is the scaling up, right? You go for growth, you go for it's sexy, and it gets you immediate pricing gains, especially if you're in an up market. But if you're building a business for the long term, I mean, you got to be building on, at least on parallel pathways, you got to be building a business model, thinking about unit economics and economies of scale. And, what does it cost us to acquire that additional person? Knowing when to stop going for growth is, I think, critical in a young company's, toolkit, because that's the point at which you say, look, we've got enough growth. We know how to grow. Now we're going to figure out a way to convert this growth into making money, and you can't put it off too long. I mean, I've seen fintech, especially in the US, a lot of fintech is regulatory arbitrage, which is they make money because they don't have to play by the same set of rules that the insurance companies, the banks have to, which is great. But those are not scalable models because if you get bigger, you are going to get regulated. It's just a matter of time. So I think that the question I always ask is, okay, I can see how you're growing, but what are your plans for when the regulatory arbitrage ends? How do you plan to differentiate yourself? Because you're Lemonade, you're a fintech, insurance company. I can understand why you can sell rental insurance cheaper than State Farm. But rental insurance is not a big market. If you want to become a big insurance company, you got to go after the big parts of the insurance market. And guess what? There you're going to hit regulatory thresholds. What are your plans? Are you setting aside capital to cover that need? And one of the ways you can separate the firms that are just scaling up from the firms that are actually building business models is whether they have answers to questions like those.
That's very, very helpful insight, I think, for all of us here trying to make it in the tech space. Going a little bit deeper on that question, I think you've seen how the pendulum has completely swung probably in the last 6 months or 12 months, right? Companies were just trying to deliver growth, and especially pre-IPO stage, now everyone is, including VCs, including all of those funds that have sort of dried out. They're pushing companies to think about profitability maybe for the first time in a decade or in 15 years, right? How do you see this movement in the market, and what's that going to do? Is that healthy with all of the companies that will probably run out of business at this time, right? Run out of cash.
This is what I meant about too much risk capital chasing too few deals. There are some bad ideas. Let's face it, there's nothing noble about being an entrepreneur just because you're an entrepreneur. There's nothing amazing about startups just because it's a startup, right? If you make disruption too easy by giving capital to startups with bad business models, you'll accomplish the worst of all scenarios. You'll have the startup with a bad business model scaling up with access to capital. It'll destroy the status quo because they can't compete with you. But the disruptors can't survive either because they haven't built a business model. And then you're left with neither the status quo nor the disruptors. I mean, we're in a bad shape as a society if that's the case. It's a point I've been making about the ride-sharing companies for the last 15 years is they're amazing at scaling up. Look at how quickly Uber went from one city to 415. But it's an awful business model. It's an awful business model because it has no stickiness to it. I have no loyalty to Uber or Lyft. I'll take whichever is cheaper. The drivers have no loyalty. You can't build a business with no stickiness because it cannot be monetized easily. It took Uber almost 11 years or 12 years from the time of its founding to come to this profound realization that they have to make money. I mean, it shouldn't take 12 years before you get that, wake up moment. But for a lot of startups, it's almost like founders are so, and I don't blame them because they talk to VCs. VCs talk to them about scaling up. It's the VCs, the suppliers of capital, I think, are more to blame than the founders on this one because they are the ones who push for scaling up. And guess what? You get what you deserve. You got scaling machines that can't build a business.
And at the end of the day, not only the VCs, but when you get to what they call, I guess, the finish line, I think it's the starting line once you IPO the company. But a lot of these founders, they see IPO as sort of the finish line, right? And the market was paying insane multiples or infinite multiples if you even got some companies with zero revenue IPOing and getting piles of cash, right?
This,
And giving the
this is
wrong
why,
incentive.
this is why I think it's difficult to draw a kind of moral from the story is if you're a founder who's not interested in building a business, you're like a trader, right? You start a business, you flip it. You flip it to the public investors and you move on. You've accomplished. I'm not going to call you immoral or unethical for what you did. You did what you came to do. You can't remove the responsibility of public market investors who also paid that price. There's a collective responsibility here. And I think that many of these young startups have been traded rather than invested in. When you trade, you're going to get bad habits built into business models because when you traded, you try to push up the metrics that people trade on, whether it's users, subscribers, But there is always a point in time in markets where markets wake up and say, but when are you going to start making money? And you got to be ready for that.
Professor, I think that's all of the questions I had. It was a very nice talking to you, and I just wanted to thank you for your time. I think it was very, very clarifying for me and for a lot of us here in the Brazilian market, and to get your insight is very, very special. Thank you very much. Então é isso, pessoal. Infelizmente, chegamos ao fim do nosso bate-papo, mas saiba que ele é apenas uma amostra do que está por vir. No Asas Connect, você terá a chance de mergulhar em várias rodadas de palestras e conversas como essa, com a participação de grandes profissionais referências no mercado. Como a gente mostrou no início aqui da live, temos um cupom de 20% de desconto para aqueles que ainda não compraram o ingresso do evento Asas Connect. O cupom está agora aparecendo aqui, ó, na telinha, tá? Também vai ficar disponível na descrição do vídeo. Então aproveita essa oportunidade e garante a sua vaga. Queria agradecer também ao professor Damodaran por ter aceitado o nosso convite e compartilhar tanto conhecimento e experiência com a gente. Muito obrigado também a todos vocês que nos assistiram e lembrem-se de nos acompanhar nas redes sociais para mais atualizações sobre o evento Asas Connect. Uma boa noite e um bom descanso para todo mundo. Até mais!